bond market. You're probably familiar with it. Nonetheless, what's relevant or what's important is kind of what we've been doing. And with anything in life, it's going to probably get worse before it gets better. But to explain what this all is, in case you don't know, I want to just jump onto an easier financial chart that's a little bit easier to understand. I'm going to jump over to the Dow for a second, and I'm going to pull everything off of this. And what we're looking at is the Dow Industrial Average from 1897 far left and current day on the far right. If you're familiar with the Fibonacci equation, essentially, just like pi, it's a sum that infinitely sums. So 1 plus 1 is 2. What comes after 1? 2. 1 plus 2 is 3. What comes after 2? 3. And that goes on forever. It never ends. Now, the Fibonacci equation is just going to measure the 100th level to 0. And so if we look at the Great Depression, and I'm going to make sure I've got these on the right candles here. And yep, that's correct. And then that's correct. And what I'm going to do is I'm going to make these lines extend throughout the entire timeline. And so we've got almost 100 years of history here. And what's crazy about it is, even though this isn't the correct way to do it, you're supposed to measure each drop and each the most recent low and the most recent high. But nonetheless, even at this point, I mean, if you try to put these lines any closer than where they came out on their natural math equation, where they summed to as far as results, you couldn't. And even if we get into current time today, you couldn't put them on the line any closer if you tried. And this is almost 100 years later from when we established what our 100 and our 0 level is. And so if we go into more current timelines, which will be here, right, we measured the 2008, we're going to notice now, I'm going to delete the other one, then we get even more dialed in. And if we want to go into really the most recent one to measure, 2020, when the CARES Act was done and the American Financial Rescue Act was done, we printed half the currency that was in supply. Then we get spot on again with these levels. Now, there is a theory by Dr. Elliott. He was a great mathematician back in the Great Depression, but essentially what his concept was, when we get into Elliott waves theory, is there is 5 waves. 1 is up, 2 is down, 3 is up, 4 is down, 5 is up. That's the end of your cycle. And when you get into an extended wave to the downside, which you can have extended to the upside, which we've been in, and I can show you that too. But when we look at the downside, that's what's going to take us into more relevant financial charts that we should be looking at. So here's kind of the educated guess, for lack of better terms. What we're going to be doing is what we've been doing. This was 1. This was 1, this was 2 back to the upside, then we go down to 3 and win. That's the only thing that we can't say definitively, but we can say definitively that we get down there. This will be 4, then this will be 5. Now, once we get to this point, and the reason why that point is relevant, and it's a measured move for the record, but where that is relevant is, well, that's what we hit at the worst case scenario last time. Well, how do we know that's exactly where we're going to go? Well, when we got into this triangle pattern, which is here where we get stuck into this pattern, all that line comes from is the measured width of our actual triangle when we started this. And so when we broke out of it, we could have gone either here, if we went to the upside, which we didn't, but because we broke out to the downside, we have to measure that downside out here. And that's how we get to that level. So again, it's going to get worse before it gets better. The reality is that we get into Fed funds rate. When is it going to be adjusted? And the chances are that's probably going to happen once we get either to September or November. September, for you and me, our tax returns are due 12/31. With the Fed Reserve, it's 9/30. That's the fiscal year end for them. So that's probably where we're going to see a change. When we get to the end of or really the beginning of November, once the election's over, that's also when we could see policy change, or probably most likely in the middle of those 2 days. Think about what happened with the elections last year. When we started accessing the gas from the reserve, the price drop was done in that 60 days leading up to the window of elections. And chances are we're going to see the same thing rinse and repeat itself, as it always happens. Now, the one thing definitively, when that's an interesting thing to say when it comes to financial charts, there's very little in the financial markets you can say definitively 100%, not a probability, not a 99% chance, 100%, except for the unemployment market. And so what this little red line is showing is that every time we've broken above 3.9% when it comes to unemployment, that's usually when the Fed step back in and drop rates. And they've been manipulating the data as much as they possibly can. Doesn't matter what side of the aisle you're on politics wise, but the point is this data has been manipulated. So when you have unemployment dropping artificially, you have inflation rising, not artificially, but technically artificially with the amount of currency we've printed. Well, the only thing that can happen is the Fed funds to maintain, and if not, adjust higher. And so we likely will see an adjustment higher on the Fed funds rate. The reality is that the Fed funds target rate is at 5.875. It's been that since 2022, when they did the how am I forgetting what it's called right now? There's an event that's done once a year in July or August. It's basically the Super Bowl of financial events, and right now, for some reason, the name is escaping me. The reason why it's the financial Super Bowl, this is when all the central bank powers come to the United States. They listen to the keynote speaker, which is the Honorable Mr. Powell. And he shares, here's where we're at data-wise, here's what our projections look like, here's what our plan is, here's what we're going to do. And then as we have the FOMC meeting minutes that are released monthly or on their meetings, that's what changes the Fed policy as they adjust as data comes in. So it's a matter of time before the unemployment breaks 3.9%. And as the real estate industry, as cyclical as it's been or always been, it will remain cyclical, but it's due to come in our favor, meaning that, yes, we're always the first ones laid off. We're always the first ones out of work, but we're always the first ones back in. So first out, first in. And granted, we have to make sure we can find our borrowers that maintain employment. But the point is that the Fed funds rate will get a relief. It's just a matter of time. Can't say definitively when, but we're at every breaking point we should have been. We've been on that breaking point now for a couple of years. The yield curve has been inverted, which is basically the DEFCON 5 alarm that's been blinking now for 18 months or coming up on 18 months, which whenever that's been inverted, that's always been a sign of the economic decline. But we're here and we're close. How close are we? Well, if we look at Fannie Mae's newsletter but announcement they published about 2 weeks, maybe 3 weeks ago now, they started buying bonds. Now, what's the difference between Fannie Mae and the Federal Reserve? It comes from the same bank account, so to speak. And the fact that they have started purchasing again, with Freddie joining in shortly thereafter, while it's not in the billions or trillions measurement level as the Fed Reserve, the point is they've started, it comes from the same source. In my opinion, the reason that Fannie and Freddie are starting this what is the word I'm looking for? What do cruise ships do? Voyage. Well, they started this because indirectly they can have a direct impact on markets. But the central bank power or the Federal Reserve does not have to emit lowering of rates or buying bonds. Thus, they can continue to manipulate the data to show that they are not buying down or buying the market essentially, discreetly, indirectly, artificially having the same effect to a degree. The point is, as any cruise ship takes a half hour to make a left turn or right turn, or I'm sorry, a U-turn, it's a slow moving ship, just like they went up slowly-ish, and it's going to be a slow decline of the Fed funds rate, but probably going to go up first before it goes down. And we just have to let all that play out in the timeline that it's going to play out. And the biggest key point here is for our central bank power to ensure and illustrate to the other central bank powers around the world that our economy is fine, because, so to speak, that has to remain fine. If it doesn't, then our dollar power goes down. That's the crux of it all. But the point is that they're going to continue to manipulate the data as long as they can until they have to show their hand, and that's usually going to be on the river card if you play poker, and that's what's going to give us our later down the line timelines in the year.